Now, Zenith Bank Group has posted a 5% increase in its post-tax profits. CEO of the bank, Ebenezer Onyago, says the outlook for the second half of the year is that of caution. He also adds that the bank plans to leverage its digital technology to drive growth and build new products.
It's been a very challenging period. The headwinds are everywhere, but what we are simply doing is navigating the headwinds. And I think the biggest part of our achievement is the kind of talent we have. Without sounding immodest, I think I dare say that we have the best-in-class talent who are creatively expressive, they are audacious, they are committed, they are resilient, and we keep looking at positives we see in the market, but it's been a very tough and challenging year. But thanks to the team who have continued to sustain the culture. Again, you know, we have a legacy. Part of the things we have that is unique to us is the rich legacy of our founder, which compels us to really drive productivity no matter the situation. So that's what we see that is really the key elements driving our performance.
Still on the top line now, I'd like you to speak to give us some insight basically on what was playing out there with the gross earnings as well and your profits.
Well, when you look at the gross earnings, where we recorded a 17% double-digit growth, which we haven't seen in the last 5 years. So it's an impressive performance, and if you dimension that, you see that interest income increased by about 19% and non-interest income by 18%. But the bigger part of that non-interest income is the massive growth we see in digital and retail banking commission and fees. Year on year, we recorded a 45% increase. And that speaks to the real intensity with which we are driving the retail and digital business. And I think we're happy with the progress we are making, and we are going to sustain it.
Yeah, because I see that the bank is going on this diversification drive, more or less trying to get more out of different units there. But I'd like you to speak to that drive and more or less how you're reaping those benefits.
What we've been doing is first carrying out what I'll call intelligent automation. With that intelligent automation, we are revamping our processes and driving efficiency. And that's also helping us to build some kind of proprietary capabilities that's helping us to build new business verticals across existing segments, and also getting deeper and more intense in the retail journey. Is helping us to more realize, understand the customer journey, looking at gaps and other services where product and services that we need to, develop. And what we have also seen is product development is also a steady thing with the application of the unique digital capabilities that we are building.
Yeah, because earlier you were talking about the headwinds here. We're seeing higher, well, it's a global phenomenon. I'm talking about the inflation challenge here. We're also seeing higher energy costs play out as well as a fallout from the events we're seeing play out from Eastern Europe here with Russia and Ukraine. But I'd like to speak to how more or less the bank is trying to navigate the challenges coming up with these headwinds playing out there.
It's a very, very unusual situation we face. You see that one, risk premium is elevated. I mean, talking about each particular geography in the world. Then you also see the idiosyncratic risks, which is the unique and the micro risk level as it affects individual organizations. So it's like you have a situation where you have fire burning at two ends of the stick. What we are doing is at this time, there are a lot of whistles and bells going off. So we are being cautious, watching to see what do we need to respond to, what do we need to watch, what do we need to change. So we are using that to really adapt in terms of our customer engagement, varying the terms and conditions in which we are carrying out our business, and also being extremely, extremely cautious, because in an environment where risk is elevated tremendously, not only in your geography, in the global business, you can't be too bullish in terms of risk acquisition. So that's why if you look at the loan book, we grew by a modest 5%, whereas deposit grew by 11%. And what we've also done is also to recognize that because of the elevated risk environment, we had to increase the level of provision for impairment. So I think it's a rather very, very challenging moment. But what we are looking at steadily is how are we responding, because the key drivers of this inflation, like you mentioned, you have energy costs for Nigeria, you have food costs, the cost of food, you also have exchange rate issues. So we dimension each one of them, and we are looking at responses that we can deal with. How we respond to the exchange rate issue is completely different from how, the food price is beyond our own, but exchange rate risk, we are responding differently in terms of how we carry on with our foreign exchange-related transactions and obligations. So it's a tough situation, and we pray that there will be a silver bullet someday somewhere.
Yeah, definitely. Everybody wants to see things come out better then. But then you earlier alluded to your loan book, and I would like to take you up on that, more or less looking at it in a way, more or less as to how it impacts your interest income, and more or less what was seen play out. Yes, I know that interest income was quite impressive. It came up about 18%. But how's that relationship been with the loan book and the interest income?
Well, banking is a margin business. And I told you about the efficiency we are driving with technology. What we're saying is that with technology, we've improved our treasury management. And improvement of that treasury management is helping us lower down the cost of funds. If you look at our net interest margin, it moved from 6.4% to 7.1%. Notwithstanding the fact that it was a period of depressed and very low yield. But we're saying that with the application of the automation, we are finding gaps, we are finding areas where we can extract more value. So what you see, that movement in interest income is actually driven by efficiency with which we are managing the treasury and the loan book.
Yeah, because quarter on quarter, I saw that decline when you look at the loan book, and I'm trying to imagine what the bank is trying to do to get it up in the next quarter then.
I think it's all about what we see. You know, typically a Zenith Bank, we choose and pick the kind of deals we do. And this period, we've just sat back, we are looking at things and taking off what we think is a healthy risk for us to acquire. So we'll look at it, and it's not going to be a case of us it's not the time to be bullish in terms of growing the loan book. We will grow for as long as we have the right type of business that fits our risk appetite.
Because looking at that Fitch rating, talking about they affirmed your long-term issuer default rating at B with a stable outlook there. I'd like to get your thoughts on this rating. More or less, they listed some very positives for Zenith Bank in terms of creditworthiness and all of that. I'd like you to speak to some of this.
Well, the Fitch rating we are happy about that because it typifies the overall quality of the operations of Zenith in terms of product efficiency, in terms of the adequacy of our capital, in terms of the quality of our loan book. And it's all about the kind of culture we've had. It's a culture of discipline, it's a culture of high ethics and pragmatism with which we approach business. So I think the Fitch rating speaks to the fact that, yes, the legacy of our founder is being sustained. So, and again, it could have been better, but for the macro risk elements in the economy.
Yeah, but what's the story on asset quality this time around, looking at all the events that have played out and how the bank has also managed to manage some of these headwinds?
Well, maintaining a very healthy asset quality is a tradition we have here. And everybody holds him or herself accountable. So because of that, it's a self-driven process. I don't really need to scream and shout as a CEO. People own their processes, they own their product, they own their loan book. So you know that it's almost like people can't stand their loan going bad. People feel bad when their loan go bad. So you have that unique culture of that discipline, discipline, high ethics, and we follow it up. And we are also quick in terms of looking and identifying the early warning signals. When we see it, if a business is challenged, we're also very proactive in looking at restructuring, making sure that we give you a repayment plan that aligns with your cash flow. I think I would say it's a matter of culture that we have here.
Because, yeah, I was going to go into some of the ratios, but I think you've already kind of spoken to more or less the NPL ratios there. I'd like to give you the chance to speak around your coverage ratio. We see that's up around 131%.
Well, that's also to reflect what we see in the environment. We're just making that provision because we can't we'll be living in denial if we say that the risk in the environment is not elevated. So what you see there is a reflection and interpretation of how we see the environment.
Yeah, because on your capital adequacy ratios, the total capital adequacy ratio is about 21% as well.
Yes, we always like to maintain a healthy buffer, especially when you look at prudential ratio. That speaks to the fact that we have a headroom. We have a headroom in terms of us growing our loan book. And we have two things going for us there. Apart from the headroom we have with respect to capital adequacy, we also have the liquidity. We have the treasury power, we have a deep pocket. So, but we are governed by the principles of the advice of the banker of, is it 1860 or 1863? You don't just book loan because you have ample liquidity. So we like to operate from that place of comfort. So it helps us to respond. When we find a good opportunity, we can respond as quickly as we can.
And I'd like to know how you're hinging your strategy, looking at what we've seen kind of here that we've had, and talking about scenario planning as a bank in Nigeria, one of the biggest banks in Nigeria in terms of asset quality. How are you more or less strategizing, looking at the challenges that we're seeing? And more or less, I'd like to get a guidance from you in terms of what your outlook is for the second half of the year, bearing in mind the interest rate environment.
Well, the outlook for the second half of the year will be that of caution. We are going to remain very cautious. And we also have a determination to see that the run rate is improved. And we think we can do that. And again, in terms of strategy and scenario planning, Zenith has always been very deep in scenario planning. And I give you an instance. About 7 years ago, we looked at the foreign exchange situation in the country. And we felt that, look, there's no way we can sustain the foreign exchange demand of the market by simply depending on what comes from the center, which is largely coming from oil, proceeds from oil. We started the non-oil export seminar, which we started as an advocacy to draw the attention of the market to the fact that this is a huge opportunity. This is another big alternative and sustainable alternative to dependence on crude proceeds. And today, Zenith has emerged as the dominant export bank in the country. So we are deep when it comes to scenario planning, and we are looking at different options in terms of what to do. But the key thing that will be driving us is how we are applying the digital technology we have, the capability that are unique to us to build new products, to revamp our processes. We all offer the same product, it's homogeneous, but the delivery is different. That's where Zenith stands head and shoulder above the closest rival.